Hi, welcome. Get yourself a cup of coffee. It's gonna be a long video, but trust me, it's also going to be one of the most important videos you're gonna watch in your lifetime. In this free course, I will be covering all the aspects of stock investing, and I will make it as simple as possible so that you are able to take away from this video and be well informed in various aspects, even when you have little to no financial knowledge whatsoever. As of the recording of this video, I am still working as a commercial senior analyst in a Malaysian public listed company, and my portfolio of experience over more than 4 years includes analyzing companies, performing market research, financial modeling, valuation and return analysis, and early this year, I have been transferred to work under a corporate venture capital department where I get to look at startups that require funding and etc. On the side, I have been investing for more than 3 years already. I started off with the Malaysian Stock Exchange, but very quickly pivoted off and went full force into the US stock market for a lot of reasons that I've shared before in my previous videos. And speaking of videos, I've uploaded more than 120 videos on YouTube over the course of 2 years, which primarily covers the basics of finance, investing, and business. And in aggregate, I have more than 1.5 million views under my belt already. I have timestamps down below, so feel free to skip ahead to whichever section you like. And before you do that, I would greatly appreciate it if you can give this video a thumbs up and subscribe if you'd like to see more videos like this. And also, I would be grateful if you can also share this video out onto your social medias so that we are able to reach out to more people with this info-packed video. Sharing is caring, right? Okay, thank you very much for that. And without further ado, let's start with understanding what is investing. Now, broadly speaking, investing simply means putting your money to work so that over time, you are able to generate positive returns or profits instead of letting it just sit in your bank account. And before I even explain the mechanics of it, I want you to know that investing is very personal because it involves your current financial position, your earning power, your life circumstances, whether you have commitments or dependents or not, your emotional readiness, and what you are trying to achieve with your money. And all of that makes the basic foundation that will later on affect the way you choose your investment strategy, horizon, and whatnot, which I will unpack later in this video. That said, investing is closely tied to this concept of time value of money. That means the sum of money you have today is worth more than the sum of money in the future. And that is because over time, inflation eats away at the value of your cash. And usually that may come in the form of 2 to 4% every single year. And just to give you an idea, if you have $100,000 today, after a year, assuming a 2% inflation, it's going to be worth $98,000. And a year later, another 2% inflation eats away at it and you will end up with $96,040. And another year, it will be $94,119. Yes, hopefully you are starting to see what I'm trying to say. Inflation eats away at your money in a compounding interest manner, which if you reverse it, then it's the same for investing. You are growing your money in a compounding interest manner. So as a general idea, this is why people invest their money, and for the most part, people want to beat the baseline 2% inflation. So if they are able to generate a return of say 5% on their investments, that means the net return for their money in that particular year is a net growth of 3%. And speaking of return, that will tie back closely to your personal risk appetite, which again is very personal, like what I've mentioned to you before. There is a rule of thumb that I always tell people: if your country's central bank or just banks in general are giving you a fixed deposit rate of say 2% per year, that means any investments you are taking that gives you a potential return higher than 2%, say 8%, that difference of 6%, that is technically the additional risk that you are taking on with your investments. And let's not confuse between risk and volatility, because they are two very different components in investing, and sometimes people tend to mix up the two of them. Risk in the financial world is defined as the chance that an outcome or investment's actual gains will differ from an expected outcome or return, and that includes the possibility of losing some or all of an original investment. Whereas for volatility, that is the market value of your investments, which will definitely fluctuate over time. And in the context of stock market, it changes or fluctuates almost every single second during the market hours, because there are always people trading the stocks, and depending on the circumstances in the real world, there may be days where the value of your investment goes up due to good news from the companies, country, or just the whole world's economy as a whole. and vice versa, there will also be days where the value of your investment goes down as well. And as an investor, you need to understand that risk usually correlates to reward, which is what you typically hear about, risk to reward ratio. What that means is the more reward you are chasing, usually that comes with greater risk, and vice versa, going for defensive investments with lower expected reward comes with a lower risk. And make no mistake, there is no right or wrong, because different people will interpret the risk to reward ratio differently. And again, depending on your personal circumstances, some of you may be more comfortable taking on more risk, while some of you may not be that comfortable in taking more risk. There is no need to be ashamed of that, because the last thing you want is to take on excessive risk and end up losing your money because of greed. And that is something all investors are trying to find and balance, especially in their early days of investing, striking the balance between risk and reward. Now, with that in mind, we can move on to choosing your investment assets. This picture pretty much summarizes the overall picture of potential return versus the expected risk. Starting from the left, we have cash, which technically has no risk of losing their value other than to inflation. And don't be surprised, a lot of the people that I know in real life only keeps cash in their bank account and not venture any further, which sadly means their money is eroding as time progresses. Next, we have fixed deposits, where, as I've mentioned earlier, it's almost risk-free, where the only risk you are taking is the risk of the bank you deposit your money with going bankrupt. And even then, that risk is very minimal to none, because banks are highly regulated entities, and most of the countries will insure your money up to a certain amount. And in Malaysia's case, it's up to 250,000 by PIDM, or in Singapore's case, it is insured up to 75,000 Sing dollars by the SDIC. And I believe most, if not all, countries will have similar insurance, just that maybe the insured amount may differ from one to another. Now, once we leave the blue color region on the left, we start to venture into the riskier assets that can bring you better reward. And the main difference here is that the white region has little to no insurance at all, which essentially means you are on your own. And this is where the investment world gets complicated. But don't worry, we take it one at a time. Starting with property, it means you are investing in real estate, and in most cases, it's high-rise buildings like condominiums or apartments, where you essentially try to generate profit through renting them out to tenants. That difference between the rent you are receiving and the loan installment that you are paying your bank to finance your property is essentially the rental yield most property investors are looking for. I am personally not a fan of property investments because it is highly illiquid, which means you can't just buy and sell immediately and convert them into cash and vice versa, because a property transaction involves a lot of real-world processes like legal agreements, construction phases, defects check, renovation, dealing with tenants, and etc. And I am by no means an expert in property, so I would highly recommend you to read up more on it or speak to an experienced property investor if you are interested in it. Next, we have shares. Some people call it stocks, while some people call it equities. And without complicating things, they are all actually referring to the same thing. Stocks are essentially a form of certificate that gives you a partial ownership in a business or company like Apple, Google, Amazon, Tesla, and whatever that may be. If you just simply Google search Apple's share price, you will see that it is currently worth $154.09 per share. That means for every one Apple stock you buy, you need to pay this amount through something that we call a stock broker that functions just like a bank account, which I will elaborate later at the stock brokerage chapter. The last item on this graph at the further right are what people call the alternative investments, which can comprise of higher risk options that may not be suitable for the everyday people. For example, venture capital, private equity, future contracts on commodities, option contracts, cryptocurrency, luxury watches, arts, antiques, the list goes on and on. They are by no means bad per se, but they all would require a different skill set to value them, as they are more volatile and usually highly dependent on the supply and demand of it. Anyways, I personally think that stocks strike the perfect balance of all, being highly liquid, lower entry barrier, much more versatile, and give you a huge range of stocks ranging from super low risk ones to the super high risk ones. So it definitely can serve people that comes from all walks of life. But keep in mind, when it comes to investing, you are not just investing in individual stocks and you stop your analysis there. You are actually also investing in the country's economy and its currency as well. So if you are investing in the US, you are actually allocating your investment capital to be denominated in the US dollar. That means any fluctuations in the US dollar as well as the US politics is going to affect the outcome of your investments, and that is the same case with any other country. If you are investing in Bursa Malaysia, for example, you are effectively pinning your money down on Ringgit Malaysia as well as the Malaysian politics. I'm not gonna judge, but I trust you would have taken a little bit of effort to just quickly Google search what's happening in the world, and you should eventually come to the conclusion that the US stock market is probably where everything will lead you towards to. And speaking of that, the stock market typically comprises two main assets, stocks and ETFs, which stands for exchange traded funds. The concept of investing with stocks or ETFs is pretty simple actually. You can either profit from the dividends paid out by the company, or you can profit from the growth in the capital value of the stock that you own. So what are dividends? Well, a dividend is simply a distribution from a company's earnings to shareholders like all of us. They can come in the form of cash dividends or share dividends. But to make things simpler for you, as long as you own stocks of a company by a certain date that we call it the dividend X date, then you are entitled to be paid the dividend based on the number of stocks that you hold in the company. Dividend investing or profiting from these periodical cash distributions is generally safer and less volatile because dividend investors usually invest in highly stable companies with proven track record of operations and etc. And these companies probably have reached the peak of their business cycle and model and no longer innovating as much already. Hence, the volatility of the share prices of these companies are usually much more lower compared to growth companies, which I will talk about it in a second. It's by no means a good or bad thing. It is again a different way of investing depending on your personal goal and risk appetite. Another way to profit from stock investing is through growth investing. This investment style or strategy is focused on growing your invested capital through investing in companies that are constantly innovating or trying to grow their profits quarter after quarter, year after year. And because the nature of them being constantly innovating, they are usually companies that make changes to their business operations and offerings more rapidly in relative to dividend companies, and hence that innovation could be a double-edged sword, whereby if it works, then it's great to grow the profits, but if the innovation doesn't work, it could be a waste of time and resource, which in the competitive stock market where companies compete with one another ferociously could spell the doom for a lot of companies. Hence why investors typically assign more risk and volatility associated with growth investing. But you need to know that nothing is as straightforward as it is in the stock market because it is very dynamic and changes the way it behaves from time to time. We can always argue that growth companies are actually the better option moving forward because they prevent themselves from being disrupted by new and upcoming competitors. Hence why they are constantly reinvesting their profits into their business instead of paying cash dividends to shareholders. While on the other end, dividend companies, they make little to no effort to change the way they do their business. Hence, some may also argue that they are actually much more riskier because they are slowly but surely losing their edge to newer companies as time goes by. So to each of its own, I personally prefer to be investing in growth companies for the reasons that I've just mentioned. Instead of receiving cash dividends myself, why not let the company reinvest and use the cash on my behalf and grow its value through an increased share price, right? I can always sell later if I need that cash for cash flow purposes or whatnot. So there is no definite right or wrong in this context. Now let's move on to the second main asset in the stock market that we call the exchange traded funds, ETFs. I have a dedicated 18 minutes video explaining what is ETF investing, so I highly recommend you to check it out because there is a lot of things that I've covered there. Anyways, just to give you a brief idea, ETFs are essentially a bucket of say 50 or 100 or 500 stocks that trade under one ticker symbol. just like how you would trade a stock on your brokerage account. There are thousands of different ETFs out there, but the most popular of them all is the S&P 500 index that tracks the value of the stocks of the 500 largest US companies by market cap. And because the US economy has been the greatest growth story for the longest time, the S&P 500 index is able to bring an annualized return of 10.49% from the year of 1926 until the end of 2021, and precisely because of that, it is considered as the primary benchmark for the US stock market, if not the global stock market, which means if your investment cannot beat the annualized return of 10.49% per annum, then you are considered underperforming whether you like it or not. Because any other layman investors can just throw their money into the S&P 500 index, do nothing, and still earn a solid 10.49% per annum. And make no mistake, 10.49% is annualized return, yes, but that does not mean you will be guaranteed that return for every single year, because from time to time, there are recessions or bear markets in the US or world economy. So there are years, if not decades, that the S&P 500 could be under the water, and understandably, not every investors have the emotional or financial capability to hold it through. So their returns will definitely differ greatly if they so choose to buy high and sell low, if you get what I mean. Anyways, back to the drawing board. ETF is just another instrument in the stock market that allows you to diversify your investments, because not everyone is comfortable or have the time and energy to chase the highs and lows of individual stocks like Apple or Google or Tesla, etc. So they would typically opt for ETFs because it is a lower risk and reward investment that has a pretty transparent track record of historical performance. And although past performance is no guarantee of future results, they wouldn't differ too far away from it, because time and time again, the thematic structure of the ETF have proven to work and will likely to continue to work as long as the world dynamics don't change that drastically, which common sense would tell you everything in the scale of the world takes time to develop, and we as an investor will usually have time to react to it in a lot of cases. And just like stocks, there are growth or dividend ETFs as well, and the way you trade it is exactly the same, 100%. Next up, we are going to talk about how to actually start investing in stocks or ETFs. Let me give you a very simple analogy. Imagine an apple in a supermarket. That is the exact same thing as a stock in a stock market. There are of course different stock markets in the world, same as how you would have 5 or 10 different supermarkets all around you. But let's just say you have set your eyes on this particular brand of apple that only sells at this supermarket. So now all you have to do is travel to the supermarket, right? Imagine in front of you, you have different cars to drive to the supermarket. You have a normal passenger car, you have a sports car, you have a van, you have a bus. They all can do the job, right? Yes, that is the exact same thing with stock brokerage accounts, because on a very high level, they all do more or less the same thing, except you would have slightly different experiences with all of them, and they all have their own pros and cons. You can argue driving a normal passenger car to the supermarket is more fuel saving, right? Likewise, another person can argue that driving a sports car to the supermarket can save you time because it can accelerate faster. Both are right, there is no right or wrong, so the power of choice is in your hands to choose the best car or the best brokerage account in this context to get to that stock in the stock market. For your information, there are dozens of stockbrokers out there, and each of them differ ever so slightly in various aspects. So if I were to ask you to compare and choose the best out of them, that would probably take you days if not weeks of research and analysis. So to save you time, I have actually done that comparison analysis for you in this dedicated 25 minutes video, so feel free to check it out. Some of the numbers are slightly outdated, but the gist of it is still there. You can still safely refer to it as a general guidance. And by the way, before you jump off the video and open an account with any stockbroker out there, you will have to decide which country you like to invest in. Yes, I know we all hate that part. At least that's the case for me. But to help you make that decision, just look at the stock market index for your country or just any other country. If it doesn't outperform the US S&P 500 index, then it's best to assume that any investments outside of the US is probably gonna give you a lower return than the S&P 500 index. So assuming you have time traveled and watched the video that I've compared the 14 different stockbrokers, you would know that I put a lot of emphasis into these two things. One, security of the platform. This to me is the most important factor because yes, you can invest your money at the lowest fee with a lot of free gifts and discounts and whatsoever. But if things go south and the broker itself goes into asset freeze or liquidation, your capital or your money is equally frozen, if not jeopardized, until the relevant financial regulators step in to solve the issue, which could take months if not years to solve, sometimes even never. And also number two, the reliability of order execution. I know it sounds very sophisticated, but to make it simple for you, the most fundamental reason why you need a stock brokerage account is to help you to buy and sell stocks. Very simple. And if it cannot do that basic job properly, or it has some slight gimmicks here and there where you are actually being taxed by the broker because of something that we call payment for order flow, PFOF, then that would also be equally disadvantaged to you as an investor. Ask yourself, would you want to go to an expensive restaurant just to know that when your salmon steak arrives, it's actually a frozen salmon that is not fresh at all, but you paid the full price expecting a fresh salmon? You wouldn't want that, right? Yes, that's the exact same thing with stockbrokers. Things may look nice outside, but the inside is what matters. Anyways, assuming you can't be bothered to watch my broker comparison video, I will just jump the gun and recommend you Interactive Brokers, which is the largest broker outside of the US with more than 40 years of history. Comes with the best, if not the best, fee package that you can find out there. Offers you the most flexible currency funding options as well as the flexibility to invest in 33 different countries in the world that includes major markets such as US, UK, China, Hong Kong, and etc. Well, yes, look no further. This is the broker that you are looking for. Before I move on, I will also highly recommend you to check out my Investing for Beginners playlist over here because there is a little bit of learning curve when it comes to getting your account set up, funded and ready for trading. But no worries, if you still have any questions, you can always leave it in the comments section down below or DM me via Instagram. All of my website and social media links are in the description box below. Okay, so how much money should you invest? Well, again, this depends on what you are trying to achieve, and obviously the amount of disposable income you're gonna have is going to increase over time as you grow your earning power or get new streams of income. And again, obviously, the more you invest, the more changes you're gonna see in terms of percentage. For example, $1,000 invested compared to $100,000 invested. With a 5% profit, that would translate to a difference of $50 as opposed to $5,000. And I am by no means discouraging you that you shouldn't invest just because your initial capital is small. The fact is, we all start small. You just got to give it time and let compounding interest do its job. As a general rule of thumb, at least 10% of your monthly paycheck should ideally go directly into your investment account so that you can make sure you have allocated a fixed amount of money to work for you rather than you working for money month after month, year after year. Why 10%? That's because beginners tend to make mistakes or select the wrong investment vehicles or assets at the beginning of their investing journey. So starting with just a small 10% leaves you room for mistakes that won't be too costly to make. And over the time, when you have a much better grasp of what you are doing, trust me, you will be more drawn into the investment world and you will eventually invest more than 10% of your monthly income. And in terms of dollar value, contrary to many's belief, you don't actually have to be rich in order to start investing, because trust me, rich people don't start by being rich. They start by being either lucky or they are far-sighted enough to start investing early, be it through stocks or just any business they may be in. Hence why they are as rich as you see right now. With more and more offerings from stockbrokers like fractional shares trading in the US, you can actually start investing with a very small amount by buying a portion of a full stock. Like for example, if you can't afford to buy a full Apple share that can cost you $154 per share, you can also buy half of it by paying $77 per trade. Yes, that's one of the beauty of the stock market. And honestly, not many brokers offer this feature unlike Interactive Brokers. Shout out to them. But as a general rule of thumb again, since you are probably watching this from outside of the US, you may need to convert your money from your local currency, in my case Malaysian ringgit, into US dollar before you can trade US stock. What happens is when you convert your money, currency exchanges, be it remittance company or banks, will take a small portion out of it as part of the conversion fees. Hence why it's always best to send a sizable amount each time you convert your money so that you are minimizing the impact of currency conversion fees. How much is enough? I would say start with at least $100 a month, and if you are able to afford more than that, even better. The more you can send in one go, the more money you can save. That's just the way it is. I would recommend you to do it via a non-bank remittance company such as Wise. They offer the best rates while being 100% transparent with the fees you are paying them for each transfer. I have a full suite of videos on these funding tutorials, so do remember to check them out in my playlist. Now, before you're all too excited with opening an account and simply investing your money left and right, you should ideally be familiar with performing fundamental analysis. Fundamental analysis is a method of calculating or determining a stock's intrinsic value by looking at its economic data and financial data, and this is a super deep topic that we can spend hours and hours to talk about, but I will cover the very basic fundamentals that you will need so that you can take this away and do your own homework instead. The reason why you want to do fundamental analysis on the stocks of the companies you are investing in is because you don't want to pay too much for something that is worth much less than its actual valuation. For example, an apple in the supermarket can cost maybe $2, but what if suddenly on the side of it there is this so-called super organic apple that sells at $10 each? Do you think that the organic component of it is worth 10 divided by 2, 5 times the value of a normal apple? Well, don't jump to a conclusion just yet, because it can very well be worth the 5 times valuation. Who knows, scientists actually discovered that the $10 apple is able to prolong your lifespan for 10 days each apple. You never know, right? So it's your job as an investor to collate those data, connect the dots, and determine whether or not the stock is actually worth its price that you can see displayed on the stock market, or in your case, the stock price that you see when you Google search it. So back to the topic, fundamental analysis can cover a broad range of items, but very briefly, it is divided into two: quantitative analysis and qualitative analysis. Let's start with quantitative analysis, and as its name goes, quantitative or quantity refers to the information that you can see in the form of numbers and amounts. There is a whole plethora of information that this video will not do it justice, but just to give you a gist of it, you need to start by understanding the very basic of financials. That means you need to be able to understand the commonly used financial terms such as revenue, EBITDA, earnings, return on equity, profit margins, EBITDA margins, financial ratios like earnings per share, EPS ratio, price to earnings, PE ratio, debt to equity, DE ratio, and so many more. And to help you begin your journey with all of them, you can simply Google and read out each of them. And you can also start with looking for something that we call the financial statements issued by public listed companies, where they are required by the law to publish all of their company's financial data on a quarterly and annual basis. The financial statements usually come in three. Firstly, the profits and loss P&L statement. Second, the balance sheet. And thirdly, the cash flow statements. The P&L shows you the entire picture of the company's business operations, which includes main financial data such as revenue, cost of goods sold, operating expenses, financing expenses, corporate income taxes, and lastly, the net income for the accounting period. The balance sheet gives you a glimpse on the company's assets, liabilities, and shareholders' equity, and it usually comes in this formula of assets equals to liabilities plus shareholders' equity. Assets are things that the company owns and use to run their business, such as fixed assets like land, machinery, equipment, buildings, etc. Cash and cash equivalents, account receivables, intangible assets, and so many more. Liabilities are the money the company owes to the other parties, for example, the short or long-term debt or loan that they took to run their business. Deferred tax liabilities, payables that needs to be settled, and etc. And the third component of it is the shareholders' equity, which is the money attributable to the owners of a business or its shareholders. Sometimes this is better known as net asset, since you subtract liabilities out of assets, which effectively means the net amount of asset that shareholders own after taking out whatever they owe to the other parties. Anyways, with all of the financial data that you can gather, you can then connect them and turn them into meaningful interpretations that can give you a good idea of the intrinsic value of any given company. and that can be done in two forms. Number one, simple analysis, where you piece together the statistics like financial ratios and growth metrics and etc. And number two, complex analysis, where you use those financial data as input and run them through complex calculation models like discounted cash flow (DCF) or dividend discount model (DDM). I think I won't be able to do them justice by squeezing all of them into this video, so feel free to search them up online. There are tons of materials, articles and videos teaching you all of it, but just before you feel overwhelmed, ideally of course you will want to know how to do all of your quantitative analysis. But in my opinion, if you can cover simple analysis at the very least, then you already have a pretty solid fundamental to begin with. The next form of fundamental analysis comes in the name of qualitative analysis, and as the name suggests, quality means you're actually using subjective judgment to analyze a company's value based on data that doesn't come in the form of numbers. For example, the management's experience and expertise, the company's business mode, the reputation of the brand, their potential business partners, and so many more. Qualitative analysis is arguably the harder one to be properly digested because unquantifiable metrics means they can be equally mixed with a lot of noise and sometimes marketing gimmicks, because understandably, company managements are always trying to upsell the value of their company to investors and shareholders, because no one in their right mind would downplay the potential of the company, which will invite doubt and decline in the company's value. It just doesn't make any sense, right? For example, if you walk into any supermarket, do you think any of the employee in their right mind would advise you that the quality of the items sold there is actually worse off than the supermarket across the street? No, right? And that is why qualitative analysis can be easily affected through biased information channels, and hence it is our job as an investor to clearly differentiate which of the data are noise and which of them are actually signals. And when you have attained that skill through experiences to properly segregate them, you will have a much clearer head on what to focus on in your research, rather than being panicked every single day when a negative news article pops out. Now, another form of analysis is what we call the technical analysis, which is commonly associated with people that sit in front of a lot of monitors looking at the stock charts and whatnot. And just like fundamental analysis, technical analysis is just another tool in the world of finance that is typically used by traders to predict future price movement of a stock, because patterns in the stock market would usually repeat themselves based on its trading price, volume, and implied volatility. Do you need to learn technical analysis as an investor? I would say no, it is not a priority, but it's always a good practice to not limit yourself when it comes to learning, because learning is a lifelong process, and the last thing you want is to stop learning and get devoured by your own ego. There are professional short-term traders that use fundamental analysis to support their charting process, while there are also professional investors that use technical analysis to time their entry and exits, so there is no right or wrong in this context. Anyways, technical analysis is usually a study on the supply and demand forces that can be reflected, again, on the trading prices, volume, and volatility. If more people are suddenly all buying into a company, then you can actually conclude from the price chart itself that there are certain good news that have just released or is about to release. And since technical analysis is able to see the charts in minutes or even seconds, they are again another tool for you to get that slightest bit of advantage compared to the other investors or traders out there. And without going too deep into the rabbit hole of technical analysis, here are a few common groups of indicators that traders usually look at. Number 1, price trends, chart patterns, volume and momentum indicators, oscillators, moving averages, and last but not least, my personal favorite, support and resistance levels. So for what it's worth, you don't really have to be a master of every one of it. I personally would recommend you to start with something simple like the 50 or 200 days moving averages, as well as the support and resistance levels, which are both pretty beginner friendly in my opinion. Anyways, I'm not an expert in technical analysis whatsoever. I would recommend you to refer to reliable sources to learn more about it, and if you like it in the form of videos, which I presume you are since you are here, I would recommend you this YouTuber called Rainer Teo. He has a lot of resources on his channel which can keep you busy for a while. Now, you have learned the basics of them all, but now you want to build up your own stock portfolio and you don't know how much to allocate to get the best outcome. No worries, I totally understand where you come from because I was just like you when I started. Portfolio allocation is again a very personal and subjective topic, but let me give you a few sample portfolios published by Investopedia, which I think is pretty representative of how I would personally interpret it. So starting from the left, you have conservative portfolios with low risk and reward, up to the very right where you have a very aggressive portfolio which can give you a higher risk and reward. The most conservative portfolio, as you can see here, consists of 60 to 65% of fixed income securities aka bonds and another 25 to 30% in stocks, with the remainder 5 to 15% in cash. The main goal of this portfolio is to actually protect the principal value of your money, which is why some people call it the capital preservation portfolio, where you barely beat the inflation, but most of the time you don't actually beat the market benchmark aka the S&P 500 index. This portfolio is typically suited for investors with very low risk tolerance, and it can be due to personal risk appetite or just general life circumstances where they have a lot of dependents and cannot afford to take on more risk, hence they would opt for such a portfolio. If you want to be slightly more aggressive, you can replace this fixed income securities portion with index ETFs like the all world ETFs, which are more stable and less volatile than the S&P 500 ETF. You can check them out in this video for a list of them if you want to. The second portfolio we have here is the moderately aggressive portfolio, which is somewhat in the middle of conservative and aggressive. This portfolio has 50 to 55% in stocks, 35 to 40% in bonds, or like I've said, diversified ETFs, and the remaining 5 to 10% in cash. The idea of this portfolio is that you have an almost 50-50 mix of growth and defensive components, so you are sort of getting the best out of both worlds, especially if you can afford to take on more risk as you have a longer time horizon of say more than 5 years to invest. The third portfolio here, dubbed as the very aggressive portfolio, almost completely eliminates the defensive component, whereby 80 or more % of the portfolio comprises growth component in the form of stocks, while the remainder of it sits either in defensive components or just cash in general. I personally prefer this mixture where I have around 70% in growth stocks like Tesla and about 50% more in established blue chip companies like Apple, Google and Amazon, and the rest of it just sit in the form of cash. The reason why I am this aggressive is because I am able to absorb the volatility of the stock market very well, plus I have a very long investment horizon because I am still technically 27 years old this year, so there is definitely a very long runway to go for me, which may or may not be the case for you or a lot of people. So just because I prefer this portfolio doesn't necessarily mean this is the best for you. Again, adjust according to your personal circumstances. Anyways, if we take just a step back, we need to remember that stocks or investment portfolio is just one part of our personal wealth allocation. There are still retirement funds, emergency funds, liquid cash, property investments, and etc. So having a good mix of everything in the appropriate weightage will definitely make you a more well-rounded individual financially, rather than just from an investor's point of view. Remember that preserving your wealth is almost as important as growing your wealth, as your net worth grows over time. So you will definitely want to rebalance your portfolio as time progresses. Alright, so now you are ready to jump into the market, but how much should you invest and how fast should you deploy your capital? Well, here we are. There are two ways to invest your money, either through something that we call lump sum investing, where you deploy all, if not majority of your capital all at once, or through something that we call dollar cost averaging, DCA, where you invest a fixed amount of money into an investment on a regular basis, usually in smaller chunks on a monthly or bi-monthly basis. Whatever, the idea of it is to absorb the volatility so that you are buying when the market is going up and also buying when the market is going down, and over time you actually average out and get a better return as opposed to lump sum investing, which can be disastrous if the initial timing of your investment is not on point. Again, there is no right or wrong because some of you can actually absorb the volatility and ignore the price movements. Then by all means, lump sum investing is definitely the way to go. In fact, some studies show that lump sum investing outperforms DCA most of the time. So for what it's worth, this is definitely a viable option. However, there is a catch of course. Not everyone is able to stick their gut and hold through tough periods, especially during market downfalls, and a lot of them would actually panic sell when they see a huge chunk of their life savings got eaten away by the stock market, and they ended up realizing more and more losses as they rinse and repeat that mistake again and again, which is why DCA comes into the picture, where you always stick to the schedule and just invest consistently. And that way, you take the emotion part out of investing and just constantly building up your position in a quality company over time. And what happens is DCA yields better outcome for most people. Anyways, if you want a more detailed explanation on how to DCA, what mistakes to avoid during DCA, check out these 3 videos I've made before. I've covered all the data and numbers you need to know so that you can get a more in-depth idea on this investment strategy. Now, sourcing for data is crucial in your investment journey because you will need them for your fundamental analysis, as I've just covered. Here are some of the best sources for free data that you can opt for. We'll start with quantitative analysis data, aka the numbers. You can go for websites like Yahoo Finance, where you can get accurate financial data in the form of 3 financial statements, both in annual and quarterly format. And likewise, you can also go for Morningstar, which is my personal favorite because they have a vast array of data from financials, operating performance, valuation ratios, and so many more. And also recently, I've been really digging into TIKR, ticker, where they also have a lot of live news coverage as well as financial data that you can easily export and download it if you choose to massage the data by yourselves. Why not, right? If you want another free alternative, then you can also go for investing.com, which is also another solid source of information as well. And as for qualitative analysis, oh well, there are a ton of resources you can go for. For accurate news data, you can go for Bloomberg, which is my personal favorite, and I'm a happy subscriber myself. You can also go for other news sites such as CNBC and Wall Street Journal, which I also frequently use as well. And if you are someone that have zero to no clue about the financial jargons and investment definitions, then I would highly recommend you to start with Investopedia. They have some of the most accurate write-up with a lot of detailed explanations. And this is also where I started learning all the financial jargons when I first started out my current job over 4 years ago. Trust me, Investopedia is all you need. As for books, there are a plethora of books out there that you can read. And although I'm a huge proponent of reading regardless of whichever format, I totally understand that not everyone have the patience of going through an entire book page by page, because I am precisely that kind of people. So for that, you can actually just Google search for a summary of the books online. They should be able to do more or less the same. For books, I would recommend you Rich Dad Poor Dad by Robert Kiyosaki, as well as The Psychology of Money by Morgan Housel, so that you can understand the basics of money and finance. Then when you are ready, you can go for more advanced books like The Intelligent Investor by Benjamin Graham. And after that, you should already have a better grasp of everything, and trust me, you will know what book to look for next. And when you're done with official websites, books and whatnot, I would also suggest you to go for second opinions, where there will be a mix of opinion and arguments from all perspectives, which can be good or bad depending on how you take them. These are informal sources such as from Reddit or Laureate forums, YouTube videos, Twitter posts, blogs, and so many more. But of course, take it with a pinch of salt, because informal sources tend to have a good mix of good and bad advice, sometimes biased ones. But make no mistake, as an investor, it's best to hear both sides of the opinions so that you are able to collect more data and information, rather than just being purely bullish or bearish towards a certain company, and that may spell danger for your money as well. So try to connect the dots yourself, and you will eventually evolve into a more well-rounded investor as time progresses. Alright, I believe that should be all the basics a beginner needs to know to kickstart their investing journey. As I've mentioned time and time again in this video, there is no right or wrong approach when it comes to investing, and know that everyone is built differently and come from different backgrounds. But the main differentiator between a good investor that actually grows his or her money over time and a gambler that loses his or her money through risky bets are the attitude and mindset to learn from mistakes and not give up just because you had a hiccup or suffer from some losses here and there. Make no mistake, all investors will have their fair share of losses. I had my fair share of 5-digit losses at the starting days of my investing journey, but over the time, I've made better and better decisions and I've managed to recoup all of my initial losses. And honestly, that is what you should strive for, because this is a lifelong journey, and the last thing you want is to let greed take over you with the mindset to get rich quick. Trust me, that mindset bites back most of the time, even when we are fully conscious of what we are doing. Okay, I hope you found this long video informative. Feel free to share it with your friends and family, and if you have any questions, don't be shy to leave them down below, or you can also find me via my website and social media links, all down in the description box below. Thank you very much for watching, and as usual, I will see you in the next one.